Okay, so welcome back, everybody. Now, before I move on or say anything further, everything that you learned up to from chapter 5 and 6, right? We've got to see what periodic inventory looks like. Now, what I'm going to tell you now is I want you to go ahead and place chapter 5 and chapter 6. I want you to place that aside. Okay? Don't forget it because you will be tested again on it, on the difference between them. But for now, I want you to just put it aside and behold, because now we're going to be learning the second part, which is the perpetual inventory. And what I've heard from many students is they actually like this a lot better. It's the easiest form and it's the best form. All right, and I'll show you why. Okay, so again, we talked about merchandising inventory, right? Our main goal is to be able to convert cash into goods and then goods into sales and then in sales into cash, all right? And again, we are mainly focused on merchandising inventory, which means that we are either a retail or a wholesaler store, okay? So we're in the works of being a merchandising company. All right. Now, of course, with that, this is again review what is included when it comes to inventory. All right, and the things that you will see is often going to be included in the cost of goods sold is going to be obviously the original purchase price that you purchased the items for, any sales tax if you have to pay for it, and as well as any freight expense, which is also known as just shipping, regular shipping. But you may incur shipping and handling fees. So if you have like a glass item, you may have to pay a little more additional to protect your items. Other things too could be storage fees, expedited fees, foreign fees. Other than that, you may incur them. But again, for the sake of this class, all that you're really going to see is your purchase price and freight expense, okay? But that doesn't mean that those things do not exist, okay? Everything okay there?
Oh, yep, sorry, I'm not muted.
Okay. All right. So, again, now we're going to be looking at our inventory tracking methods. All right. So, again, we got periodic and we got perpetual. So again, we're going to eliminate periodic from our brains for now and focus on perpetual inventory. So again, the definition of perpetual is consistently or constantly or continuously, whichever word that you would like to apply. It doesn't matter because as long as you know that you're constantly updating your inventory. So that means every time we make a purchase of inventory, right? And this is also going to be, a characteristics of it. You don't technically have to have a physical count, right? You can basically, without being, having it necessarily done, you can make the predictions just based off to keeping track of your inventory, right? So that means all purchases that you make, right, that usually increases your inventory. That is going to be a determining factor of how you keep track of your inventory because you're constantly buying, therefore you're just adding. And another factor that actually affects your inventory is going to be your sales. Every time you make a sale of an item, you are going to eliminate and subtract it from your inventory immediately. So the true difference is that when we looked at periodic inventory, we recognized it as an expense, right? We categorized it as an expense, and at the end of the period, right, that's when we actually do a conversion entry to recognize that this is how much inventory we have on hand, okay? But for perpetual, the true difference is that everything and anything will go straight into inventory, okay? That means you're going to record it directly as an asset. No ifs, ands, or buts about it. It's not an expense. it's straight into the inventory asset account. Okay? So with that being said, let's look at our first example of a perpetual purchase. Okay? So here on July 1st, all right, we have XYZ company purchasing 100 toys costing $5.65 each. Okay? For each of the for each toys at Toys U. Okay? Freight cost was $100. So record this transaction.
Okay, well, if it all goes into inventory,
Mm-hmm.
it's going to be, well, the description will it be inventory or will it be toys?
You can do inventory, but because we were buying a specific item, what did we buy?
We bought toys.
Mm-hmm.
So toys,
Mm-hmm.
and it will be for the whole amount of the 665
Okay.
on the debit.
Good. So in this case, everything goes into inventory, right? That's this main assumption. That means even if there's a freight expense or a freight charge, you're just going to place it into inventory. So you are correct. It's going to be inventory toys, right? And of course, whether you place it on accounts payable or you paid it on cash, right? And you're going to take all the total amount, and you're right, it is for the $665. So here we took the purchase price of $5.65. We multiplied it by the 100 items to get us a grand total of $565. But because everything's going to go into inventory, we also tacked on that extra $100 for the freight. So everything's going to go straight into inventory at $665. And that's it. Any questions on how to do perpetual inventory purchases?
Kind of looks easier.
Yeah, yes.
No.
So my mentality is teach the harder stuff first, and then the easy stuff comes last. Yes. So that is it for chapter 7.1. Yes. Because we've recognized this before, right? We recognize that when we make purchase of inventory, but this time instead of having to deal with purchase expense, freight expense, blah, 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 right? This time, everything just goes into inventory. It's straightforward. Boom. Okay? So now, of course, when we're diving into the chapter 7.2 is that now we're going to be looking at when we need to make our purchase returns and allowances. So again, the reason why we do allowances or returns is for the one reason. I mean, not for the one reason, for many reasons, right? You could have broken items, defective items. They accidentally shipped you out the wrong items, right? Maybe there's a cheaper vendor out there that can provide you the same item, same quality, but for a cheaper price. Or we just don't like their service at all. Okay? Many reasons why we can do this, right? And of course, as a vendor or a wholesaler, right, you definitely want to try to keep your us as a customer, because ultimately we're buying thousands of units from them. We are pretty much a big bulk of their the production of their items, right? We're the big people that help them sell the stuff. So they want to try to keep our company by throwing in other things such as maybe personal discounts, right? They might even do special offers, even unlimited returns, XYZ, or money back guaranteed. Okay, that's just on their side. So let's go ahead and take an example of this. Let's go ahead and look at what happened on January 1st, which you purchased a total of 100 coffee mugs on an account from Cuppy's Co., costing $1.25 each. Freight cost was $100. So how do we record this transaction?
So it's going to be the same. It's going to be, well, the date, and then
Okay.
the coffee mugs
Uh-huh.
as a description, and then the 100, or excuse me, $225 in the debit.
Okay. So yes, everything goes into inventory. So coffee mugs is our inventory, right? And because we had one thing, which was to make sure that you place it on an account, so it's accounts payable. And by you calculating the 125 plus the 100, that's correct. You do get 225 for your coffee mugs. Okay? Now let's go ahead and move into scenario 1. Well, what happens when on January 5th, okay, you received the items and found that 10 of those coffee mugs were broken? All right? And you request for a full refund for the broken mugs, and the vendor grants you a full refund. So, how do you record this transaction? Okay?
You would take the 10 coffee mugs and multiply it by the purchase price of, oh no, because you're going to include the freight, right?
No, 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 no. Freight, you can never refund freight.
You would multiply it by the $1.25. So 10
Yes.
times 125.
Okay. All right, good.
Would be $12.50.
All right, so we saw for the total amount, but what account are we going to be taking it out of?
We're going to take it out of the accounts payable on the debit side.
Mm-hmm.
And then we're going to credit our inventory or our coffee mugs on the credit side.
Perfect. That's exactly what you do because we placed it we placed our when we originally purchased it. It's all in our inventory. So here, because we know that it's in the inventory, we decided to just take it right directly out. So again, everything that goes into inventory, you're going to take everything out of inventory. So that is correct. You're going to take it out for $12.50. See? Much easier, right?
Yeah.
Okay.
Yeah.
Now, what happens if January 5th, sorry, I'm hearing reverb.
Yeah.
All
There we go.
right. So here on here on January 5th, right? You received your items and you found that 25 of those coffee mugs were the wrong size. Okay? You ask for a refund on the extra large cups, and the vendor offers you a 20% discount. Right? So, how do you record this transaction?
Let's see here. Okay, so I'm definitely overthinking it. That's why. um, so, all right. Well, the mugs are going to be in the description, right?
That's one of the
And I'm
accounts.
going to. Okay. So I. Well, obviously, it's going to be the purchase returns and allowances, or is it? Is it? Okay, I'm stymied on this one for right now until I figure out which. Is there inventory returns and purchases, or is it just purchases, returns, and allowances?
Okay. All right. So, okay, we're
Or is it
trying.
accounts payable? Accounts payable.
Okay, so accounts payable, yes, because originally we purchased them on an account. If we're getting a refund or our money back for the discount, right? We need to decrease the amount that we owe. So that's for surely going to be the first account.
accounts payable, the debit will be, let's see,
$6.25.
Good. Okay. Now, secondly, what account are you going to take that $6.25 out of?
Your inventory.
You have to take it out of your inventory because why?
So your coffee mugs.
Mm-hmm.
Because everything went in there. That's the only pot it can come out of.
Exactly. Exactly. You only placed it in one spot and one spot only. So therefore, where else are you going to take it out of? There is no such thing as inventory returns. Okay. This one's just going to come directly out of inventory. So in this case, that is correct. You're going to take the $6.25 out of inventory. Okay, because that's where you placed it all. There is all you recorded it originally as an inventory asset. So therefore, you only have one place to take it out of. Okay. So any questions in regards to these purchase returns and allowances? So in this case, the concept behind it is the same because ultimately we made a purchase and now we're returning it or we're getting it an allowance. So that's why the title is called Purchase Returns and Allowances. But however, we're looking at perpetual inventory. We don't care because right now it's not an expense anymore. Once you make an expense, you can't really fix an expense. You can only decrease or increase the expense. And in this case, because we've established that all of these items are inventory items, we can freely take in or out of our stuff because we know where we place it. They're all in inventory. Okay? So in this case, when we make a return, straight out of inventory. When it comes to an allowance, straight out of inventory. Okay? All right? Any other questions in regards to purchase returns and allowances?
I have nothing yet.
Okay. So, then again, with 7.3, we're also going to be dealing with purchase discounts, right? So again, we'll be looking at our infamous, very famous little terms here, right? 2%, 15 to 30, meaning you take a 2% discount if you pay within 15 days. If not, you need to pay the full thing in 30. Now, what this is there are two different types of discounts that you can apply when you're dealing with terms, right? So again, when you're dealing with terms, you can either recognize the discount now or you can recognize the discount later. Okay? So again, we looked at this before when we were doing our periodic inventory, right? We got to look at what it looks like when we actually establish a net method of recording the purchase discounts or whether we use the gross method, right? So again, let's go ahead and practice this. So net meaning you take the discount now, gross meaning you take the discount later. So again, let's learn the first one first, which is the net method. So here on January 1st, you purchased 100 coffee mugs from Cuppies Co. at $1.25 each, and freight was $100, right? Terms are 5%, 10, net 30. Record the transaction using the perpetual inventory tracking method. Okay? So, if we know what does net mean to us, if it means to take the discount now, how would you calculate this?
Alright, so let's see here. Oops. All right, if you're taking it right now, you're going to put in the description of the coffee mugs
Mm-hmm.
and freight included with the discount already applied
Mm-hmm.
is $213.75.
213 is not what I got.
Hold on a minute, then let me
220.
That's a little too over.
Oh, there we go.
Oh, wait, we're still not discounting on freight, correct?
You never can discount freight.
Right, okay, that's what I did, okay.
Hang on, 125 minus 100, 18. So it's 218.75.
Perfect.
Sorry, I was doing 2% from up on
From
the term
yes,
thing instead of the 5%. I'm sorry.
that's fine.
All right.
So here we are. Right, we applied the 5% discount immediately to my coffee mugs. And I'm going to say I'm going to owe at the discounted amount. All right?
Okay.
So then scenario 1 says, well, what if on February 9 you decide to pay Cuppies Co. for the purchase amount? So how do you record this transaction? Pretty straightforward. You just make the full payment of the discounted amount, which is
218.75.
$218.75. Correct, right? Because you made the discount period, but you've already collected the discount already, right?
Right.
Now, what about scenario 2? What happens if you miss that discount? But you've already recorded it in the very beginning. So now this is the scenario where February 15, you missed the discount window. So how do you record the other remaining $6.25? Where does that $6.25 go?
It is coming out of, you still owe it, so you're doing it the same way, the inventory for the mugs.
Are we debiting our mugs or are we?
Yes, you're debiting, because you have to pay the additional $6.25, right?
Okay.
So the mugs, the description is the $6.75 debit, and then
Okay.
accounts payable is $6.25 credit.
Not this. No. That's not right.
Okay.
What else are we doing? If we decide to pay on the 15th of February, what is my transaction at hand?
Okay, I'm sorry, I didn't hear that.
If we decide to pay on February 15th and I'm recording this transaction, what am I doing here? What is my transaction about? So I'll give you a hint. Your accounts are correct, but your amount is wrong.
So you're,
So she's
Go ahead.
gonna debit it for the $6.25, but then her credit is gonna be for the full amount of the 225 because
Correct.
that's the whole
No.
amount that has to be paid, and
Yes.
you're just adding the difference.
Correct. So
Okay.
that is correct. So you were
Oh,
you were almost close. You were very close on getting the correct way. You do have to add back to the mugs because you originally discounted the mugs when you could have just left it as is. But in this case, because we were thinking we were going to pay the very next day or within the 10-day window period, but we missed it. So now we have to place it back into our inventory, which is right here. And now that we need to pay that $6.25 extra on top of what we originally owe, which is for the $218.75. So in this case, I'm going to write a check for now for the bigger amount of $225. All right. And then let's go ahead and take a look at the gross method. So, how are we going to journalize this under the gross method?
okay. Well, that is going to be the description of the coffee mugs.
Mm-hmm.
Let's see here. So that's, oops. So it's still going to be the same. It's going to be the coffee mugs, and it's going to be the $225,
Mm-hmm.
and then accounts payable for 225.
Perfect. Good. Now, what happens if scenario 1 says that I paid on February 9, right? I made my discount window. All right, that means I made it enough to take 5% off of my original price. So how am I going to journalize this time? How am I going to record this discount? Go ahead.
You're gonna debit your accounts payable
Correct.
and credit your coffee mugs.
Correct. You're going to decrease it for the 5%. And what is my 5% going to be?
$6.25.
Yes. Therefore, you're going to write a check out for those for less than $6.25. Okay? All right. So, I owe them $225, but because I made the discount period, I've made it even by distributing that $6.25 out of my inventory and also by writing a smaller check. Okay? So yes, that is what happens here. And then lastly, if we didn't even make the discount period, no worries, no fret about it because we originally placed it in for the full amount of $225. So it's pretty straightforward. We just simply pay for the full amount. That's it. All right. Any questions in regards to chapter 7.1, 2, and 3?
Don't have anything right yet.
Okay. So again, this is how you going to journalize your very first purchase, right? Whatever the inventory item is, you're going to place the item there and account, of course, what other method of way if you paid it for, okay? Other than that, you just need to make sure that everything goes into inventory and everything comes out of inventory. And here's an example of what happens when you have a returns or allowances, right? All you're doing is essentially you're just decreasing your inventory account. That's it. Nothing hard about this. You don't need to create a contra account or have a contra account, okay? This is pretty straightforward. It's easy, simple. Everything's in inventory, so you're just going to take everything out of inventory. Same thing here. We have the net versus the gross method for perpetual. All right. And that is it. Okay. So I'm going to go ahead and pause this.